Assalamualaikum warahmatullahi wabarakatuh. First of all, let me introduce you what is small and medium enterprise. Small and medium enterprise is a business that maintains a revenues, asset, or a number of employees below a certain threshold. SME play an important role in the economy, employing vast number of people and helping to shape innovations. Government regularly offer incentives including favorable tax treatment and better access to loan to help keep SME in business. SME are divided into three categories, which is micro, small, and medium enterprise. These classifications depends on two main criteria, which is sales turnover and number of employees. These classifications differ between two major sectors, which is manufacturing and service and other sector. Classifications in the manufacturing sector include businesses involved in producing, processing, and assembling goods. The classification criteria for SME in this sector are: the first one is medium enterprise. This business typically operate at a larger scale serving or international market. The second one is small enterprise. This business operate at small scales, often catering to specific market or niches. Lastly is micro enterprise. These are small business, offers a family run or home base. Classification is serving or other sector. This category includes business in retail, education, professional service, hospitality, and more. The classifications for SME in this sector are: the first one is medium enterprise. This enterprise usually have a larger service capacity and wider customer base. The second one is small enterprise. This enterprise provide essential service at a regional or a local levels. And lastly, micro enterprise. These are the smallest service providers, often run by individuals or small teams. Example of small to medium enterprise like bar, dentist, law office, hair salons, and gyms. The purpose of the article that highlight on importance and role of small and medium-sized business. This article highlight about: first, job creations and unemployment reductions. SME generate the majority of new jobs, offering opportunity with relatively lower capital costs. Second, innovation and flexibility. SME drive technology innovations and adapt rapidly to market changes compared to larger enterprise. Third, market competitiveness. SME prevent monopolizations by larger companies by fostering competitions in pricing, product, design, and efficiency. Next, economic and social stability. SME efficiently manage activities such as supply chains and distributions, complementing the operations of larger corporations. Lastly, support to larger enterprise. They contribute to GDP, export growth, and development of stable middle class, thus promoting social and political balance.
Now, let's move on to the strengths of SME in economy. Number one, increase the competitive state of the market, being a source of competitiveness and providing greater satisfaction with consumer needs. By enhancing competition, SME not only drive down price but also elevate the overall quality of goods and service available to consumers. This increased competitiveness compels the larger corporations to improve their offerings and customer service, ultimately leading to a more satisfying shopping experience for consumers. Number two, small and medium-sized enterprises show higher flexibility and strength in periods of recession. SME can quickly adjust their operation, streamline costs, and innovate new products or services, allowing them to navigate challenging economic landscape with a strength that can be critical for survival and growth in uncertain times. Number three, they ensure the potential of future big companies' development through the processes of growth in which they take part. This involvement includes providing mentorship, sharing industry expertise, and facilitating networking opportunities that are essential for young organizations. By actively participating in this initiative, they will help guide these emerging businesses and pave the way for their success in a competitive landscape. Number 4, SME also focusing on innovative processes both in technology and in management is another important feature of SME. These businesses often adopt cutting-edge technologies to streamline operation, enhance productivity, and improve customer experience. In the article also include the weaknesses of SME in economy. Number 1, they have reduced capital, which makes them vulnerable in case of economic shock. Small and medium enterprises often operate with restricted financial resources, which can hinder their ability to withstand economic shocks. In times of economic downturns or unforeseen crises, such as a financial recession or natural disaster, these businesses may lack sufficient capital reserve to cover operational costs or manage unexpected expenses. Number 2, lack of functional distribution system and access to performant and accessible marketing service. This lack of infrastructure results in challenges for businesses trying to manage their supply chains, leading to delays and inefficiency. Meanwhile, inadequate marketing resources prevent organizations from effectively promoting their offerings, limiting their reach and engagement in an increasingly competitive marketplace. Number 3, low access to new technologies. The restricted access to resources prevent this company from utilizing innovative tools and solutions, which is in turn limits their growth potential and obstruct their ability to compete with larger firms in a technology-focused marketplace. And for the last one, the lack of sufficient management and economic knowledge. This knowledge gap often leads to inefficient resources allocation, missed opportunities for growth, and an inability to adapt to changing market conditions. As a result, companies may struggle to maintain a competitive edge and achieve long-term success.
SME in Romania. First, economic contributions. SME make up 99.6% of businesses in Romania, with 88% being micro-enterprise. They play a significant role in GDP, with manufacturing SME contributing 24.5% to the economy. 2. Sectoral insights. Commerce lead with 40% of SME, higher than the EU average of 28%. Romania surpasses the EU in manufacturing SME. Third, geographical distributions. Most SME are in Bucharest, followed by Cluj and Bihor. Regions like Covasna and Lalomita have a few SME. 4. Challenges. SMEs struggle with limited R&D funding, high cost of innovations, and difficulty accessing skills, labor, and modern technology. 5. Innovations and growth. Romanian SME are advancing in IT, education, and new technology. In 2014, 26.39% of SME were involved in innovation-related activity like new product and technologies.
Now, let's move on to investment appraisal. Investment appraisal is a way that a business will assess the attractiveness of possible investment or project based on the findings of several different capital budgeting and financing techniques. This is where the user looks at the financial aspect of the change by considering the tangible costs and benefits. Next, the importance of investment appraisal. It is capable of showing a trader whether a stock or a company has long-term potential based on profitability of its future projects and aims. There are two types to calculate investment appraisal. Number 1, payback period. The payback period is the length of time between investing and the time at which that investment has broken even. To calculate the payback period, you have to take the cost of the investment and divide it by the annual cash flow. Investment with shorter payback periods are more desirable because it will take less time for an investor to receive back their capital. The second one is NPV or net present value. Net present value is the difference between the current value of cash inflows and the current value of cash outflows over a determined length of time. NPV is used to calculate the estimated profitability of a project, and it is a form of capital budgeting that accounts for the time value of money. If the NPV is positive, then it is indicate that project's predicted earnings or profit are greater than the anticipated cost. If the NPV is negative, then the reverse is true, and the project or investment might not be pursued by the company.
Right now, I'll present the topic of investment appraisal. This involves evaluating the cost and benefit of a project to determine whether it is worth undertaking. As of now, we will cover three main aspects of investment appraisal. The first one will be initial outlay, and the second one will be differential cash flow, and the third one will be terminal cash flow. Before we begin, allow me to give you an exposure about what we will be covering later. Let's start with the first one, that is initial outlay. Initial outlay refers to the total cash outflow required to start a project. This includes costs such as the purchase price of a new machine, transportation, import duties, installation, and training. The next one is differential cash flow. Differential cash flow is the net change in cash flow resulting from adopting a new project or investment compared to the existing situation. It highlights the financial benefits or costs brought by the new project. Last but not least is terminal cash. Terminal cash flow is the final cash inflow or outflow at the end of the project life, when all investments are liquidated or settled. It represents the net value recovered or incurred when the project is closed. To start off, we need to calculate the depreciation for both assets. The question already given for the new machine costing of Rm290,000 and a salvage value of 60,000 with a useful life of 5 years. Depreciation is calculated as follows, that is, cost minus with salvage value divided with useful life. So to calculate Rm290,000 will be minus with 60,000 and divided 5. You will get Rm46,000 annually for the depreciation. Repeat the same process with the old machine and you will get the depreciation amounted to 40,000 annually. When the old machine is sold, we calculate profit on disposal as sales proceed minus with net book value of the old machine. Net book value is the cost minus with accumulated depreciation. For the old machine, the costing of Rm180,000 minus with accumulated depreciation of 70,000, you will get Rm110,000. The profit with Rm150,000 minus with 110,000, you will get Rm40,000. Once you get the amount, we need to calculate the tax expenses on the disposal. With a tax rate of 24%, we just need to multiply the tax rate with the amount you get earlier, that is 40,000. The tax expenses on disposal will be Rm9,600. Once you're done with all the working calculation, now we can move on to calculate the initial outlay. For our case, the breakdown is as follows. Purchase price with Rm220,000, transportation with a cost of Rm50,000 and import duty with a cost of 35,000. Don't forget the installation of Rm20,000. This total of Rm290,000 for the new machine. Next, we add training cost of Rm95,000, giving us Rm385,000. We also include working capital requirements. Before we continue, let me explain a bit about working capital requirement. It actually refers to the amount of money a business needs to cover its day-to-day operational expenses. In this case, the working capital requirement mentioned is an increase in inventory investment of Rm45,000, which is included in the initial outlay calculation.
Finally, we deduct cash inflows, which include Rm 150,000 from selling the old machine, minus with 9,600 in tax expenses. This gives us an initial outlay of Rm 280,600. Let's discuss the differential cash flow for year 1 to year 5. This analysis compares the savings and cost of the new machine, helping us to evaluate its profitability. Saving from year 1 to year 3, the savings include an increase of sale of Rm 60,000 annually, a decrease in salaries of Rm 70,000 annually, and this results total saving of Rm 130,000 per year. For year 4 to year 5, there is an increase of sale to Rm 84,000, while salary savings remain at 70,000. The total saving for this year are Rm 154,000 annually. Costs, on the other hand, the costs remain consistent throughout the project. This brings the total cost to Rm 91,000 per year. Net income before tax. By subtracting total cost from total saving, for year 1 to year 3, the net income before tax is Rm 39,000. For year 4 to year 5, it increased to Rm 63,000. Next, we deduct 24% of corporate tax. For year 1 to year 3, the tax is 9,360. For year 4 to year 5, the tax is 50,120. For the net income after tax for year 1 to year 3 is Rm 29,640. Net income for year 4 to year 5 is Rm 7,880. Since depreciation is a non-cash expenses, we add it back to calculate the after-tax differential cash flow. For both periods, the depreciation added back is Rm 32,000. After-tax differential cash flow, this gives us Rm 61,640 for year 1 to year 3, while Rm 79,880 for year 4 to year 5. In summary, the different cash flow analysis shows steady saving and manageable costs, indicating the project's final benefits over its 5 years of lifespan. We have come to the last calculation, that is terminal cash flow. The key component of terminal cash flow is salvage value, the amount recovered from selling the project assets, and also release of working capital. At the end, project ends, any tied up working capital is released, providing additional cash inflow. In this case, salvage value of the new machine of Rm 60,000, adding back working capital of Rm 45,000, the total terminal cash inflow you will get Rm 1,500. In conclusion, investment appraisal is critical for determining for financial viability of a project. By analyzing the initial outlay, differential cash flow, and terminal cash flow, we can make informed decisions. That's all from me, and thank you for listening on how to answer the question for part A.
Assalamualaikum everyone. Now I would like to share about two powerful methods for evaluating investments, which is net present value or NPV and internal rate of return or IRR. These are both part of what we call discounted cash flow methods, and they help businesses make smarter financial decisions by considering the time value of money. So let's start with net present value. NPV measure the differences between the cash inflow and the initial outlay. Essentially, it helps you see whether its investment is worth it. The formula may look a little intimidating, but here's the simple idea. You are summing up the annual cash flows and discounting them back to today's value. This will give you the present value of all cash you expect to receive. So, when do you need to accept a project? If the NPV is positive, that means your investment will generate more value than it costs. Now, why is NPV so useful? It accounts for the true timing of benefits and costs. It also uses the time value of money, so you are working with realistic values, plus it tells you exactly how much value the project adds to the company. But it's not all perfect. NPV does have some challenges. It requires you to forecast long-term cash flows, which isn't always easy, and determining the right discount rate is crucial but tricky. Now let's talk about ARR, or internal rate of return. IRR is essentially the rate of return you are getting on your investment. It is the discount rate that makes NPV of the project equals to zero. For ARR, the rules is simple. If your ARR is higher than your cost of capital, basically your minimum required return, you should accept the project. Why most of the people like IRR? Well, it is easy to understand. It gives you the percentage return, which is intuitive. Like MPV, it considers the timing of benefits and costs and uses the time value of money. Plus, in most cases, it aligns with NPV, giving you consistent results. However, IRR isn't perfect either. It can be tedious to calculate since it often requires trial and error. And if you are comparing mutual exclusive projects, IRR might give conflicting results compared to NPV. In summary, both MPV and IRR are essential tools for evaluating investment. MPV gives you the absolute value added, while IRR shows you the percentage return. The method you choose will depend on your project and business needs. Now, we will be analyzing the net present value. First, let's calculate the payback period. The formula we use is payback period equals to initial outlay divided with differential cash flow. The initial outlay is 289,600 and the differential cash flow is 79,880. Dividing this gives us payback period 3.63 years. This tells us that it will take just over 3.5 years to recover the project's initial investment. Next, let's look at the net present value. This calculation helps us understand the value of the project by considering the present value of future cash flow discounts at rate 12%. For year 1 to year 3, the annual cash flow is 61,640. Using the present value interest factor fair value year 3, which is 2.4019, the present value is calculated 61,640 multiplied by the number, giving us 148.53 cents. For year 4 and year 5, the annual cash is 79,880. The difference in fair value is 1.2029. It is used to calculate the present value, resulting in 96.8765 cents. Finally, for year 5, there is an additional cash flow of 105. Using the fair value factor of 0.5674, the present value is calculated as 59,577. Adding these together, the total present value of cash inflow is 3,777 cents. Now, subtracting the initial outlay of 289,600 from the present value of cash inflow, we get NPV of 14,770.77 cents. Since the NPV is positive, this project adds value and is worth pursuing. Next, let's analyze the internal rate of return. This table provides a detailed breakdown of cash flows, present value interest factors, and their corresponding present value for discount rate of 13% and 15%. So let's go through it step by step. For the first step, we calculate the present value of cash flow at a discount rate of 13%. For year 1 to year 3, the cash flow is amount 61,640 annually. Using the cumulative fair value interest factor of 2.3612, we calculate a present value of 145,544.37 cents. For year 4 to year 5, the cash flow increased to 79,880 annually. The fair value interest factor for this period derived as VVA 5 minus VVA 3 get 1.1561, resulting in a present value of 92,349.27. For year 5 specifically, the cash flow is amount 105,000 with fair value factor of 0.5428. The present value is 56,994. Adding this value, the total present value of cash inflow at 13% is 294,887.64 cents. Now let's calculate the present value at discount rate of 15%.
For year 1 to year 3, the annual cash flow is same, and cumulative fair value interest factor of 2.2832, the present value is 140,736.45 cents. And for year 4 and year 5, the interest factor of 1.069, the present value is 85,391.72 cents. For year 5, the cash flow is still the same, 105,000, and the fair value factor of 0.4972 gives us a present value of 52,206. Thus, the total present value cash inflow at 50% comes to 278,334.70 cents. Next, we calculate the NPV at both discount rates. At 30%, the total present value of 294,887.64 cents is reduced by the initial outlay of 289,600, resulting in NPV 5,287.84 cents. At 50%, the total present value is 278,334.70 cents minus initial outlay give a negative NPV, which 11,265.83 cents. This show how the NPV change and the discount rate, a key aspect of understanding project feasibility. Now, to determine the IRR, we use interpolation between these two discount rates. So this is the formula. IRR equals to lower rates plus NPV positive divide NPV positive minus NPV negative. Then the total will be multiplied with higher rate minus lower rate. After substitute the value, this gives us IRR of approximately 13.64%. This rate represents the discount rate at which the project's NPV becomes zero. To conclude, the NPV at 13% is positive, indicates the project add value, while the NPV at 15% is negative, showing diminishing returns as the discount rate increases. The IRR of 13.64% exceeds the required rate of return, making this project financially attractive. This analysis provides a strong basis for deciding whether to proceed with the project, balancing both the time value of money and profitability. Based on this result, here is our recommendation. The positive NPV of 14,117.77 cents indicates that the project adds value to the company. The IRR of 13.64% is well above the required rate of return, showing significant profitability. The payback period of 3.63 years is shorter than the desired maximum of 5 years. This demonstrates a quick recovery of the initial investment. All metrics align to suggest this project is financially viable and worth pursuing.